today we're talking about tariffs again. And this has been a huge, point of conversation since, Donald Trump took office earlier this year. But what we're doing today, I think, is really different than what I've seen everywhere else. It's a conversation that needs to be had about what do these actually look like to the end consumer, what effects do tariffs have on the underlying economy, and really walking through an example of, manufacturing something overseas. What's the process look like to manufacture it, import it, pay that tariff, and then get it to the final consumer? What effects does that have on the consumer and inflation as a whole?
Yeah, exactly. Yeah, this podcast is about you. If you're listening, you're watching, this is about what does it mean? How much are we going to pay as consumers when it comes to the tariff? And this is where it's been very confusing because you see these headline tariff rates and they seem extremely high. You're talking the 15, 20, 25 plus in some instances tariff rates. And you're wondering, oh my gosh, are my goods that I'm buying going to go up that much? That seems like a lot. And we're going to break that down today. And I think that's really the important part and the crux of what we're trying to get at. And while those tariff rates are high, especially when you're talking about historically, we're at the highest levels since the early 1900s as far as tariffs go. But what that's going to mean for the end consumer is not too drastic, we think, in most cases. And so I want to get into what an example looks like and then the inflationary breakdown of how can the consumer look at it and then how does the Fed look at that.
Yeah, and so to do that, I want to take a look at, take someone like Nike manufacturing, your just standard, call it $100 pair of sneakers to make the math easy. What does that look like if you'll walk us through kind of the different cost factors and how that, correlates to tariffs?
Yeah, so there's a lot of costs that go into a pair of tennis shoes. Obviously, the materials and labor to make those shoes are only a small portion of that. So you really start with what's square one. You've got the materials that are going into that shoe, whether it's leather or some kind of, material, whatever's going into it. Then you've got the labor to put it together, sew that shoe together. And then you've got the shipping cost to take it from what we're, in this example, talking about it being produced internationally in a foreign country, shipping that across the ocean to the United States for consumer use. But even once you get it to the United States, there's a fee that goes to the retailer, whether that's some kind of sporting goods store or shoe store. There's marketing expenses, there's just the general brand and the profit margin that Nike wants to take at the end of the day. So there's a lot of things that go into that $100, but the majority of it is the brand. It is how much profit Nike wants to make and the marketing of those shoes. Obviously, we've seen from all sorts of retailers the amount of marketing that goes into that because it's a very competitive business in the apparel space. So that's a huge portion of the cost as well. So what we're really going to focus on when it comes to the tariffs are those first kind of three items being, and this is what the U.S. Customs Enforcement is focused on and really cares about, is what are the input materials costing, what's the labor costing, and how much is it costing to ship it to the United States. Once you get that cost breakdown, the combination of those three things, that's when they can decide what kind of tariff is going to be charged on those goods.
Yeah, I think that's a really important thing to point out, and kind of the point of this podcast is it's on the import price. It's that wholesaler to, Nike importing it that gets tariffed. And so in our research, that labor, those first three items, the labor, the materials, the shipping into the U.S., that costs about $10 to $30, call it around $20 for rough math, $20 whenever it's landed in the U.S. Well, that's what the tariff is being charged on. So if you have a 20% tariff on that $20, you're talking about a $4 tariff, not 20% or $20 on the $100 list price that we see. So we're trying to find a home for those $4. And as we'll get into, those $4 have to be put somewhere. They have to come from somewhere. But we're talking about $4 on this pair of shoes as opposed to $20, which is a lot easier of a battle to have.
Yeah, and I think it's also interesting. When I was doing research on this, it's interesting to determine how does U.S. Customs exactly pin down how much the input cost of these goods are, because say if Nike or another company owns their manufacturing overseas, how do they really determine what the cost is at the port? Obviously, the easiest is whenever you're buying from a supplier overseas and that invoice is the indicative number for the tariff. Well, it's a little bit more complicated if you're doing your own operations, but basically, at the end of the day, it's coming to what does the U.S. government deem as really that value of the input materials, the labor, and the shipping expense. And it kind of comes down to that. They'll use, if it's your own production, they're going to use kind of what's comparable in another transaction or something similar, and just really getting to what has gone into the goods so far, not adding extra value to it before charging that tariff. And so I think the next step of this question, now that we've determined, hey, you're getting that tariff is being charged on that $20 of that $100 pair of shoes rather than the $100, and we've determined, that's $4 now that's getting pulled out of the system. That's being paid by Nike to the U.S. government because they're the ones importing the good. How do they make up for that $4? It's going to have to come from somewhere, right?
Yeah, and they really have three options. Either they cut their margins, which no company really wants to do. That's kind of a last resort. They can raise prices. That's entirely dependent on what kind of market they're in, their ability to raise prices. You're back to your economics 101, the elasticity of demand. Certain products you can just increase your cost for or price $4. Boom, done. Or finally, work with their producers for either cost concessions or find other, levers to pull. Maybe instead of producing 10 different styles of shoe, start producing 7 with larger ordering volumes. So you reduce some costs on the manufacturing side and you can eat up some of those dollars on the front end. But those are really your three levers: the producer prices, your actual margins, and the cost of your good. Because a lot of this, like the materials, that's relatively fixed. In theory, you could downgrade certain materials, but then you're talking about really altering your product. And, this is saying for this same thing that you're getting. Because, if we just took a step down in quality, then that's a totally different product. We're having a different conversation there.
Yeah, I think that's an excellent point. And I think as companies pull these levers, it's going to become an industry by industry question of how they're going to be able to do that. For example, in apparel, to continue with the shoe example, it's a very competitive space. And while there's some brand loyalty in there, if one shoe becomes all of a sudden, significantly more expensive than another, then consumers are going to shift their preferences. And so I feel like apparel companies in particular are going to try to keep their prices as low as possible, to prevent rising them too much to the consumer. In this case, we're talking about $4. So if all 4 were passed to the consumer, maybe you're not really shaking your head at a $104 shoe versus $100. But I imagine Nike is going to work to absorb some of that in margin. Maybe $1 of that goes to they're paying out of their profits. And then maybe they work with their supplier, or if it's their own manufacturing, try to improve the supply chain so it's more efficient, costs a little bit less, therefore lower tariff at the port, easier to maintain that $100 price tag. I'd say, for those kind of goods, you're probably going to see, as a consumer, going to see $2 to $3 added to that pair of shoes. And I think the bottom line here is that thinking about the implementation of these tariffs, at least you're not saying, hey, your $100 pair of shoes is now going to cost $120. You're getting, a much smaller tariff in the first place, and then a fraction of that is actually going to go to the cost of your good. Now, of course, that's the easiest way to make up for those $4 is to charge it right to the consumer. But not every industry has the same pricing power or is able to push it to the consumer the same way. So that's when you have to go industry by industry, sector by sector, and determine, hey, how much pricing power does this company have? Is it a very specialized or luxury good, in which case they can raise prices a little bit more easily? Or is it a little bit more of a consumer, kind of a staple product where they can't help but, have to absorb some of that cost? It's going to be interesting to see on a company by company basis how they deal with that.
And I think that's an interesting point you brought up with the luxury good, with the big brand name, brand value, because something we've been talking about through this is this is a great example for a high margin good, but your low margin goods behave very differently. Particularly autos come to mind, where your dealer's making a margin. Obviously they have to, but they're getting shipped over at near sale price. Like they're not huge margins to work with. So not only are your tariffs higher, but your availability, your ability to absorb it within margin is diminished. So you really have to work on the two other levers. And with auto specifically, and they can ship cars to the US or to Australia, to Europe, to Asia. They are probably a lot less willing to cut their, the producer, VW or Audi, cut their margins in order to sell more cars over here. That might happen to some extent just because America is such a large market that they might be willing to, okay, well, we already sell them at a discount to XYZ countries because they're generally poorer countries and we want to be competitive within those. And then so, maybe fall somewhere in between for the US, but they're never going to go, real bottom of the barrel to absorb that themselves. And then on top of that too, think about, your comment made me think about Swiss watches, Rolex, for example. You have, a luxury good that's already, demand is already over supply. So there's outstanding demand, something that comes in at near full value, and Swiss tariffs are really high right now. So until we get a deal, those Rolex purchases are, maybe going to be deferred, which, how big of an impact is that to the economy? I don't know. But that's one of those things that I think you'll see kind of skipping ahead a little bit, hinting at the inflation implication is different buckets moving different directions, certain purchases being deferred, certain ones being prioritized.
Right. You very well may see categories in the more luxury space. I'll kind of lump autos in there a little bit too, because you do have alternatives here in the United States. So maybe you're willing to pay up for a nice European car. A lot of times those are the kind of European vehicles that we have in the United States already are those luxury cars. So you may be willing to pay more already for that. Plus, we've seen a little bit more leniency as far as autos go. They're kind of in that 10 to 15% tariff range. In the case of the UK, a pretty favorable deal, at least on the first 100,000 autos that they're shipping over here.
Which is about all that they ship right now. So that de minimis is allowing them to still keep shipping what they ship, but not flood the market.
Right. Whereas when you go high luxury, the Rolexes that you mentioned, you may see a different pricing dynamic on those. And then that gets us, I don't want to get too off the rails of our conversation, but it gets into the question of, hey, are you going to see items routed around different countries to try to skirt some of these tariffs? Now, the U.S. says there are penalties for doing that, but how well can they actually track that on top of all the other things they're having to keep track of in this new tariff world? So it's going to be interesting. I mean, there's still a lot to see as far as what the fallout is, how everything develops, what pricing looks like coming out of these tariffs, because now we've reached what's a relative stability compared to what we were looking at, but also kind of a high point for tariffs. I think as deals get negotiated, it's unlikely that tariffs are going to go higher, but more likely that they could come down. But we're at least living in the world right now where there have been tariff rates set on most countries, especially trading partners around the world.
Yeah, that's a good point that, while most of the major trading blocks have reached deals, there's still individual countries going after deals that didn't get one or didn't get a great deal. But also I wouldn't be surprised to see, blocks like the EU, or even, Korea, Japan still have, around the margins, make concessions here, there, find different ways to make everybody happy that brings that, total tariff amount down.
Absolutely. Let's bring us to the inflation conversation. We already talked a lot about the inflation aspect when it comes to you, the consumer, but just kind of circling back on that, while tariffs are, inflationary in nature, we don't expect, sustained or super pronounced inflation. Like we said, kind of $2 or $3 on that $100 pair of shoes. Yes, that's 2 or 3% inflation, but any given year you should expect roughly 2% or 2 to 3% inflation on, goods and services in general. Now, tariff inflation is also, it's important to note, is a one-time inflation hike. So you're going to see that bump happen one time, and then it's consistent across the board from there. So whenever we start talking about how the Fed is going to view this, they can look at it, maybe not transitory is not the right word. I kind of want to retire that one probably forever, but you have a one-time bump in the prices as far as the data goes, and then the years after that, you're looking at consistent, natural, kind of more organic inflation.
Yeah, exactly. And then on kind of as we hinted to before, because you're gonna have gives and takes in different industries, different products. Some things aren't going to go up very much. Some things are going to go up a lot. And you'll probably see just a redistribution of the consumer wallet, because the nice thing about this situation is the consumer wallet's staying pretty much stationary. It's not really growing or shrinking. And that's when you get into real bad inflation, is when the consumer wallet is growing rapidly. That's what we saw, that the Fed started trying to fix in 2022, coming out of COVID, all of the stimulus that was going into effect. The consumer wallet was ballooning at a time where you didn't have the production of goods, but the consumer wallet was growing rapidly because people had a bunch of, extra cash that they wanted to spend on stuff. And so that's when you get into an issue, well, not to mention the fiscal policy side of it, fiscal policy being the stimulus, and then the monetary policy being the zero interest rates that we were living under. So that was a whole bunch of factors that drive that compounding inflation that the Fed's really afraid of. Your wallet's staying more or less the same, so it's just a choice of allocating those dollars one place or another. Do I want to go buy a Rolex right now? Maybe not, because X, Y, or Z that I buy is a little bit more expensive. Maybe I'll defer buying a new car or buy a used car instead of a new car, because I can get this 1 year old, didn't have to pay tariffs on it, basically the same car, but it's much cheaper now, sort of thing.
Right. If you're looking at it as a consumer, your wages are going to grow, hopefully, a modest amount every single year. Your paycheck's going to slightly increase on a year-to-year basis. But beyond that, the amount that you're spending should be remaining relatively consistent depending on your life stage. You're allocating X amount to the shelter that you live in, so much to your groceries and bare necessities, so much to discretionary items, and that's starting to verge into the, extra pairs of shoes or clothes, entertainment, X amount on services. Well, if all of a sudden the goods portion of your wallet increases, if that cost increases, you're going to have fewer dollars to allocate to those services, to those other things. And Economics 101, what drives inflation is too many dollars chasing too few goods. And then you can kind of flip that and say what causes, deflation or decreased prices, or not enough dollars chasing the same amount of goods. In which case, if you're allocating more dollars to the goods that are increasing because of tariffs, you're going to have fewer dollars to allocate to everything else, which means the prices for those are going to have to come in to some extent, or the amount available of those is going to have to decrease. Well, a lot of those services and things, they're already out there. Think about your streaming services, shelter, for example. There's a certain number of homes. They're not going to start bulldozing homes. A lot of that is fixed. So it's likely that those prices will come in some while the goods slightly inflate. And when you're talking about from the Fed's perspective, that means there's going to be a counterbalance in that CPI print, because it is encapsulating all of those things. I think that's really important for both investors and consumers to think about.
It is very important too, because the CPI over the past couple of years has been the inflation's been services driven. It's been that housing services, other non-housing services, but goods have been, pretty much stagnant in price, even deflationary in some instances for a while now. So having a little bit of that offset get us back into a more normal situation where everything's inflating at a much more modest, maybe 2% level, the Fed's probably going to like that a lot more than having goods depressed and services still rapidly inflating. So it is good that we already have that dynamic going on. Net, it might not make a big difference, but it's nice to see a little bit more balance coming from that.
Right. So I think we've done a good job encapsulating that, talking about inflation. Just to kind of summarize, I think for the consumer, it's important that they know, hey, those tariffs are getting charged on the base cost of the goods coming into the ports from overseas. It's going to be a modest increase. We're not claiming that tariffs don't cause inflation. They do for those goods that are going to get imported, but only by a certain amount, which is the positive aspect of that. Two, when it comes to the data side of things, we believe that inflation on those goods is going to be offset by lower inflation, or maybe in some cases deflation in some of those other areas of, call it the CPI or PCE basket. And then hopefully looking at all of that, an all-encompassing view, it takes a little bit of the pressure off of how people feel about tariffs really impacting the economy. It certainly will have an impact, and it's, like we said, it's going to be an industry by industry basis as far as how companies react. But it's worth looking at it through that lens to understand, hey, how is this going to impact me? How's it going to impact the broader economy? And then how should the Fed be thinking about this?
Yeah, I think those are all really good points. And I'll leave us with something I've said before. I'll say it again. But corporate America generally finds a way. That's one thing that I have yet to lose faith in, is the strength of American exceptionalism, especially as far as the corporations, the capital markets, the businesses that are here, finding ways to navigate around these things, because it's happened time and time again where, there's an issue, there's this changed, that changed, but goods find a home, people reroute, they adjust, they'll transship stuff, they'll manufacture it in Mexico, they'll find a way to get around it and negate as much of the effect as possible. So I'm just holding out hope that will continue to be proven true. And that we'll just, continue on seeing that American exceptionalism in the markets as well.
Absolutely. Well, for you watching, hopefully you glean something from this episode. Feel free to drop us a like, a comment, anything you'd like to hear about in future podcasts. And Hunter, I'm sure we're not done talking about tariffs. I bet this isn't our last podcast on this topic.
I would bet not. Thanks, Victor.